Welcome to AFO Wealth Management Forward, a podcast powered by Arrowroot Family Office that's at the intersection of accounting, wealth management, behavioral finance, technology, and entrepreneurship. We help accounting firms and financial advisors grow their practice by going beyond the numbers as we learn from industry leaders and subject matter experts to discover the secret to their success. A podcast that highlights everything from the transformative power of AI to embracing the human-first approach of behavioral finance to help you understand the psychological and emotional relationships to money and meaning. Here is your host, Rory Henry, Director at Arrowroot Family Office and author of Holistic Guide to Wealth Management.
All right. Hello, everyone. Thank you for joining me for this market update. I'm joined by Chris Tidmore today. He's a CFA and CPA. He's a senior manager at Vanguard's Investment Advisor Research Center, where he focuses on investments, wealth management, and behavioral coaching. Chris formerly worked as our portfolio manager and as an options market maker on the American Stock Exchange. And then earlier in his career, he worked as an auditor, providing audit, consulting, and advisory services. Chris, thank you so much for joining me.
Thank you, Rory, for having me.
Yes, let's just dive right in here because April 2nd was a big date. The tariff announcement happened. It's been described as one of the most significant trade shocks in recent memory. And then since then, we've seen some major movement both in the stock and bond markets. Can you kind of walk us through what's unfolded over the last 2 weeks, some key developments, and what's been going on in the market?
Sure. Not to get into the weeds of, each individual thing, we can all read about that, is really it's increased volatility in the market driven by increased uncertainty at the moment, and then what's going to happen in the future. I think really it's important to understand, though, there's always episodes of increased uncertainty and volatility in the markets, whether or not that's driven by, in this case, policy or inflation or geopolitical concerns or politics, worries about the debt ceiling or profit warnings for companies. So all of those things, I think, what is important is as these things are unfolding, down markets are really never a good time. That they never come with good news or good forecasts. Right? They're always kind of, what should I do? This is going on. And along with that is it fuels the urge a lot of times to make changes.
To make the reactionary decision.
Yep, reactions. What's interesting with that is if you think about why, though, is it's human nature. Think back through time. I don't know, you were a farmer, crops weren't growing in a spot, you made changes. You either decided to grow crops in a different place or hey, you were worried about concerns safety-wise, you build a fort, right? So you made changes when things happen to you. We just don't see that tends to be a successful way of thinking about it in the markets.
Yeah. And we have recency bias, right? We're putting too much emphasis on recent events, loss aversion, right? We treat losses more so than we do equivalent gains. So that's part of the psychology of the investor there. So what can we do, especially during these market tenders, or what can we do as practitioners really to help people, through these uncertain times here, Chris?
And the one thing we really talk about a lot is, first of all, have empathy. Proactively reaching out to your clients, not telling them that they should completely ignore the things that are going on. Really helping them manage their behaviors. Right? And in response to events like these, it's what tends to cause clients harm. The clients are not trying to do anything that hurts their portfolio or hurts them achieving their goals. Everyone's heard the analogies. Clients aren't trying to shoot themselves in the foot. They're not trying to be their own worst enemy. It's an emotional, agitated kind of response to what's going on. And I know we'll get into this in more detail, but it really is helping the clients focus more on their goals long term than what's kind of currently going on in the market.
Their why, looking at things beyond just finances. What are they wanting that nest egg eventually to be in retirement? What will that allow them to do to have that long-term thinking and not be so reactionary there? I wanted to talk about the Fed and Fed Chair Powell recently spoke a couple days ago on April 16th at the Economic Club of Chicago, and he talked about the tariffs could reignite inflation, slow growth, which is really in conflict with the Fed's mandate of price stability and maximum employment. So you kind of talk about that meeting there and what Powell said and how that can affect the market.
Sure. I mean, this, current environment, I think more than what you typically see, uh, has a lot of different things going on that are all, and everyone's trying to figure out how they interact with one another.
Yeah.
And then also what things might change. And as we saw a couple weeks ago, what can change very quickly.
Yeah.
And so I think overall what's important with that is, and I think a lot of people don't fully digest this, which is the market is always continuously digesting all information and all expectations about what's going to happen in the future, the probability of those different things, all those things together make up what the current prices are in the market. They're not just thinking about what's happening now,
Yeah.
but what is Powell thinking? What is the
Yeah.
administration thinking? What are
the Q1 earnings happen? What are the, forward
Yeah,
guidance? Yeah.
exactly. And you follow that through. It doesn't mean that it's going to be right, but in order to make an investment decision that's going to have a differentiated return, could be good or
Yeah.
bad, you have to have a differentiated view than consensus of what
Yeah.
everyone's pricing in. Can you forecast what's going to happen with the policy and the economy, and then relative to how you think that's going to happen, how's that going to be priced into securities, and what are you going to kind of underweight or overweight in the portfolio? I think the best example I have of this, of even if you had all that information,
Yeah.
how something then plays out. You think about, go back 5 years from now, 5 years ago, COVID. If I were to tell you which companies were going to come out with the vaccines, right? And I was going to tell you that they were going to do this in less than a year, a lot quicker than people thought. Most people would overweight those in their portfolio, and they have done the exact opposite. They've significantly underperformed the market, even though you had all available information about what was going to actually happen with these companies. What usually goes along with that is never really a clear signal for the market, right?
Yeah.
When things, let's say this eventually, calms down, right, and it kind of goes away, you're probably late.
Right.
Go back to the COVID. I heard multiple times 5 years ago, I'm going to wait until there's a vaccine and things get back to normal before I'm going to invest. That was clearly would have been a mistake. You can even go back to the financial crisis. March of 2009 was the bottom in the equity market, and it was multiple years after that before the economy got back on track. So as I said, the market's very forward-looking and is pricing in all available information and pricing securities. So you have to have a really differentiated view and be pretty confident in that, and then figure out also what's going to happen with the investments, to take advantage of that.
Yeah. And I think was it April 5th, the tariffs took effect, but then we saw the bond market be affected. And that might have caused, people are saying, the president to make the pause, the 90-day pause there. I mean, you saw something that was out of the ordinary. You saw the bond market down, you saw the dollar down, and you saw the S&P 500 down. So is that, there are headlines saying that, is this the end of American exceptionalism, right? Those are eye-popping headlines, but those three factors, usually don't happen altogether there, Chris.
Yeah, I mean, every time in my career, it's been about 30 years, things that happen tend to rhyme, right? But they're different each time.
Yeah.
And I think trying to, think things have dramatically changed, well, they sometimes can, but usually they are more likely to rhyme, that it is
Right.
a certain environment, things might move, things that are usually uncorrelated become correlated for a period of time, things that are correlated become uncorrelated. So you can kind of end up with both things happening. We'll end up knowing what the signals were, what the things that should have been paid attention to, but we'll know after the fact.
Yeah.
And so it's really hard to kind of figure out what are the current, shorter term signals that should be looked at. I said, I think the bigger thing is, if you take a big step back, is focusing on the client's long-term goals and objectives. Have they changed? Is there a need for liquidity? I was mentioning to you, Roy, right beforehand, I was in Washington, D.C. This week, and there may be people who's got laid off, or they're in the import-export business, and they might need more liquidity in their portfolio. Or I even say, hey, that client who you've only had for a short period of time, you thought their risk tolerance was a little higher than it actually is, and they're getting unduly nervous, and maybe you do take some risk off in the portfolio, but that's a long-term thing. It also helps if you focus on the long term instead of kind of the short term with that, is that a 20%, say, downturn in the market, even if it's the combination of stocks and bonds, in their clients' long-term goals and objectives, assuming it's not tomorrow, which you'd have adjusted the liquidity for, a 20% drop in the market doesn't mean a 20% drop in their client achieving their goals. Right?
Yeah. And that's what we talk about. Michael's been on the podcast here talking about the advisor alpha framework and the behavioral coaching really being the up to 200 basis points or more. And this is where the value advisor really comes into play in helping those clients, during these market downturns.
Yeah. And, one thing to kind of connect the two is we sometimes hear this, like, do nothing. Okay.
Right.
And really, that's not what an advisor should be doing with their client. Really, it's Mr. Bogle, Jack Bogle, founder of Vanguard, he loved ships, and he had a great analogy in markets like this. Your ship is focused on a certain direction. That's where you're trying to sail to. That's your goal, right? And things will happen that will get you off course. And the goal is to get yourself back on course. And you could think about this as having a toolkit when things aren't going well. It's things like rebalancing the portfolio. It might be,
tax loss harvesting,
and maybe matching that harvesting up with, you got that low cost basis concentrated position in the portfolio. Maybe matching that up, selling some of that to harvest losses. Maybe it is shortening up some duration in the portfolio if there is a concern about liquidity, if that might be the case. And so then you said, about the behavioral coaching, we've done a lot of work in this space. And I think it all ties back to, there's a Nobel Prize winner, those aren't familiar, Paul Samuelson, who said investing should be like watching grass grow or paint dry, right? If you want to, you have that, hey, I want to gamble. There's enough online stuff you could do that. You have a part of your, 5% allocation, 2%, whatever that looks like. You make those type of bets. But with coaching and the behavioral coaching, so this advisor's alpha framework you mentioned, about 25 years ago, we created it. It was really saying that the value in an advisor either was or could be more than picking stocks and bonds. Right? It was helping clients, with spending and retirement, proper tax efficient investing, proper asset allocation, those type things. And what we found was the largest piece of that was keeping your client invested. And that's the behavioral coaching. So it's proactive, and there's no one way to do it. There's proactive coaching, like, hey, this is what we're going to experience through time, showing the clients. That's how you kind of try and set their risk allocation within the portfolio. And then there's things you're always going to have to react to. Things like this may affect people differently. As I said, job loss type stuff, their business, but also there'll be the unfortunate things as you go through life. Obviously, death, divorce, those type things. And so even why behavioral coaching is so important, you could have the best asset allocation, access to the best investments. You could have proper drawdown strategy, tax efficient investment, and you can't keep your client invested. All the rest didn't matter.
Right.
Those
are the wealth destruction type of reactionary things that can destroy portfolios.
Yeah. And we have a ton of different things that we help advisors. We provide for advisors to help them have these conversations, both the proactive and the reactive ones that I can definitely talk through.
Yeah. That's the market hindsight tool that I absolutely love. It gives people a great way to see alternate universes on what you had done if you would have pulled out your money at the bottom of the market, and then, obviously where the market went from there. Great, Chris.
Yeah.
All right, good.
I was just going to say, along with that, I think one that I've seen work a lot is kind of a zoom in to different, volatile times in the marketplace, right? Where you've seen the market pull back. It can be everything, the tech bubble bursting to 1987 to the GFC to things that even were very small blips along the way, and then zoom out, right? And you can see what the return looks like. And the market hindsight tool has a version of that in it,
Mm-hmm.
but I think that I find that tends to be quite good. The other one of I think it's really important, and what we saw too, not this week but last week, is good and bad days tend to cluster together.
Yeah.
Right? And so thinking you have the ability to time that, and if you're wrong, how bad that could be. So you think about 2 weeks ago, you had down markets on Monday and Tuesday about 5% each. You had a client who didn't stay invested, or on their own wasn't going to stay invested on Wednesday morning, and then the market rebounded 10+% that afternoon, right? So trying to time it's really hard because the good and bad days tend to cluster so much next to one another.
Yep. It's time in the market, right? Not necessarily time in the market. Yep.
Right.
Awesome. Chris, thank you so much for coming on here. Is there anything you also want to share with our audience as a final takeaway?
Yeah. I think I like to say is, like, risk is what you expect. When it's actually happening, that's when it's real, right?
Yeah.
And it really isn't a risk until that point. So, being careful, making changes during bear markets in the portfolio, both as an advisor and then also as a client. Getting through environments like this are what help build trust. We talk a lot about that in our research. We kind of say, hey, there's two parts of trust that people think about a lot, are like functional trust. You're doing what you say you're going to do. Ethical trust, right? You have their best interests in mind. And then emotional trust, though, is the squishier one. But it's what builds long relationships. It's helping them sleep better at night. And the more you can do that, the better the relationship becomes, the more likely that they're going to not make bad decisions, or not force you to make bad decisions as you move on.
Yeah, I agree. So I talk about throughout the book, return on relationship and emotional trust. As you outline in the study, it's 53% out of the three there. So I'm a big advocate of that when working with clients. All righty, Chris, thank you so much for coming on. If anybody wants to learn more about Vanguard or get in touch with you, what's the best way to do so?
The www.vanguard.com, and on there, has links to all kinds of different things related to, especially if you go to the advisor website. So you can check that down. All kinds of things under the Advisors Alpha banner, market related, but also, obviously the coaching related and the underlying financial planning, wealth management topics as well.
Perfect. Great, Chris. All right. Hope to have you back on again here in the future.
Okay. Thanks a lot, Rory.
Thanks, buddy.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.